Let's say you've got $100,000 sitting in your bank account. I mean, what you do next with that money could literally be the difference between retiring at 55 or, working well into your 70s. It's a massive decision. Do you slide it into the stock market and just let that sweet compound interest do its thing? Or do you leverage it into real estate and use the bank's money to build your wealth? This is one of the biggest financial debates out there, and today we're going to settle it with cold, hard numbers.
Okay, let's just dive right in. This is the ultimate financial showdown. 100 grand in stocks versus 100 grand in real estate. We're going to break down everything. The good, the bad, the hidden costs, and even some really surprising psychological stuff to figure out which one actually comes out on top.
So here's our game plan. First, we'll make the case for stocks. Then we'll flip the coin and make the case for real estate. After that, we'll put them side by side in a head-to-head comparison, and finally, we'll get to the final answer.
All right, let's kick things off with Section 1, the case for stocks. Now, a lot of people think they get stock market investing, but I think they seriously underestimate just how powerful it is, especially over the long haul. Its real strength, honestly, it comes down to two things: its beautiful simplicity and the absolute magic of compounding.
The scenario here is about as simple as it gets. You take your $100,000 and you put it into a broad U.S. index fund, something that just tracks the S&P 500. If you look at history, with dividends and everything, you can pretty safely expect to earn somewhere in the neighborhood of 8% to 10% a year over the long run.
Now let's see what happens when you just let that money cook. Just look at this timeline. We'll use a 9% annual return just for our math here. So after the first 10 years, your 100 grand has more than doubled to about $236,000. That's awesome. But look at the jump in the next 10 years. That is when compounding kicks into high gear, and it more than doubles again to around $560,000. Your money is now making more money than it did in that entire first decade.
And here's the best part, the real beauty of this whole strategy. There are no banks you have to get approvals from, no debt hanging over your head, and absolutely no tenants calling you at midnight about a leaky pipe. You just invest your money and you let time do all the heavy lifting for you. It's pretty much the definition of a passive investment. But wait, what if you don't just let it sit? This is the part most people miss: consistency. If you just add a mere $500 a month to that same investment, it's a strategy called dollar cost averaging, your 20-year total just skyrockets from $560,000 to well over $900,000. Now that is the power of simple, consistent investing. Okay, so that's a pretty strong case for stocks. But now, let's move on to Section 2, the case for real estate. This is where things get, a little more complicated, but also potentially a lot more profitable. The entire game changes because of one single incredibly powerful word: leverage. So, what the heck is leverage? Well, as you can see here, it's really just the idea of using borrowed money, that mortgage you get from the bank, to buy something way more expensive than you could ever afford on your own. It's the classic use other people's money strategy. You put down a little, but you get to control a lot. And this chart shows you exactly what I'm talking about. With stocks, your $100,000 investment gets you a $100,000 asset. It's a one-to-one deal. But in real estate, that same $100,000 can be a 20% down payment on a $500,000 property. The bank puts up the other $400,000, but you get to control the entire $500,000 asset.
So, why is that such a game changer? Well, let's say U.S. real estate grows at its historical average, which is about 6% a year. That 6% growth isn't on your investment, it's on the full $500,000 property value. So a 6% bump adds $30,000 to your net worth. That's a 30% return on your actual cash. 30%! That is the explosive power of leverage.
And of course, you also get rental income. A $500,000 property might pull in, say, $2 grand a month in rent. But, and this is a big but, that income gets eaten up pretty fast. Once you subtract the mortgage, insurance, property taxes, and set aside money for maintenance, you might find your actual cash flow is just $100 a month, or maybe even a little negative at first. The money isn't always in the rent, especially at the beginning.
But let's look at the long-term growth of the asset itself. That $500,000 property, growing at 6% a year, is worth almost $900,000 in 10 years. And after 20 years, it's valued at over $1.6 million. That is a staggering difference compared to that stock portfolio, and it's all thanks to leverage.
Okay, so we've got two very, very different pictures of growth here. Now it's time for Section 3, where we put them head to head. We're going to dig into the really critical trade-offs that don't just show up on a spreadsheet: the real costs, how much control you have, And this is a big one, the psychology of it all.
So here's the first thing most people totally forget about real estate, the entry fee. When you buy a property, you're not just paying the down payment. You've got closing costs, you've got inspections, loan fees, initial insurance payments, the list goes on.
And we're not talking about chump change here. These fees can easily add up to between $15,000 and $30,000. And that's money that isn't actually being invested. It's just the cost of admission to get in the door.
Now compare that to stocks. Your entry cost is, well, it's pretty much zero. You can buy an index fund with almost no fees, which means nearly all of your $100,000 starts compounding for you from day one. This table sums up the core trade-offs perfectly. Let's just walk through it real quick. First, liquidity. Stocks are super high, you can sell them in seconds. Real estate is low, it can take months to sell. Next up, control. With stocks, you have zero control. The market does what it does. With real estate, you have tons of control. You can renovate, raise rents, you can directly improve the asset's value. Then you have maintenance. None for stocks, a ton for real estate. And finally, savings. This one's really interesting. With stocks, saving more is totally voluntary. But with real estate, that monthly mortgage payment is a type of forced savings, which is an incredibly powerful psychological tool.
Now let's talk about something most people completely ignore, human behavior. The greatest strength of stocks, their liquidity, is also their biggest psychological weakness. When the markets take a 20% dive, what do a lot of people do? They panic, and they sell at the absolute worst possible time, locking in all their losses. But with real estate, you can't do that. You can't just log into an app and rage sell your house in a panic. This lack of liquidity, combined with the discipline of having to make that mortgage payment every single month, it forces you to think long-term. This is probably why so many people accidentally build wealth with property. Not because it's always better, but because the system itself prevents them from making dumb emotional mistakes.
So, after all of that, we finally get to our last section, the final answer. What should you do with your $100,000? Well, the truth is, the whole question is a little bit flawed. It's not really an either-or choice.
See, the right choice really depends on your goals. If what you want is simplicity, a low-effort approach, and just the steady, reliable power of long-term compounding, then stocks are incredibly hard to beat. But if you want the potential for faster growth using leverage, and you can handle the hands-on work and the risk that comes with it, real estate can definitely outperform. But you want to know the real answer? The real secret? The people who build serious, lasting wealth, they almost always do both. They use stocks for that consistent, diversified, low-maintenance growth, and they use real estate to take smart, leveraged risks to really accelerate their wealth building. That combination is how real financial independence is built.
So the question isn't just which one is better. The real question, the one that actually matters for your future, is this: what are you going to do with your $100,000?